600 7-Elevens are closing. That's the last place Americans spend when they've cut everything else. If your neighbors have stopped buying a $2 coffee, how do you think they're going to handle a mortgage payment? Let's break this down and see how a coffee and a mortgage payment have a lot to do with each other.
7-Eleven closing 645 locations, GameStop closing 470, Foot Locker closing 400, Forever 21 closing all remaining stores, Eddie Bauer closing all by April 30th, Walgreens winding down 1,200, Dollar Tree closing nearly 1,000, Wendy's closing 300, Kroger closing 60. The financial press is covering each one as a separate story. A brand pivot here, a restructuring there. Nobody's connecting them, because when you connect them, the picture isn't a series of corporate decisions, it's a map of where the American consumer stops spending and what happens to the neighborhoods they left behind. Seven and I Holdings, the parent company of 7-Eleven, told its investors in their own earnings report, personal consumption began to soften, particularly among low-income households, as inflation continued to weigh on spending. That's not an analyst. That's the company operating 13,000 convenience stores, telling its shareholders what the register data shows. By the end of this video, you'll understand what consumers stopped buying and why it isn't coming back, which American cities are being hit hardest by name, and what happens to property values and school districts when a retail corridor goes dark. Nobody drives to a convenience store on purpose. You stop on the way. The convenience store business model runs on discretionary friction. The spend that happens because you're there and you have a few dollars that aren't spoken for. When that money disappears, the convenience store is the first business model that breaks. Nielsen IQ confirmed it. 1 in 2 consumers citing high prices as the reason they visit less. 41% avoiding impulse purchases entirely. Convenience store sales declined in both dollars and volume in 2025. Transaction counts inside the store flat at best. C-stores saw double the traffic decline of the broader food service industry. Upside analyzed 10 billion retail transactions and found a clean split. Households below $75,000 spent 18% less on fuel and 11% less at convenience stores year over year. Households above $75,000 spent 9% more on fuel and 52% more at convenience stores. 53% of Americans set a formal budget for 2026, up from 46% a year earlier. Biggest single-year jump in YouGov's tracking history. When a population shifts from spending whatever's left over to planning every dollar in advance, the business model built on impulse breaks structurally. The consumer who learned to budget doesn't unlearn it. The stop they eliminated doesn't come back. Pandemic savings gone, credit maxed. Then gas spiked $1 per gallon in March. The discretionary money was eliminated. If you work in retail, convenience, restaurant, specialty, you're watching this in real time. Your transaction counts are falling. The consumer walking through your door is not the consumer your business plan was written for. They're budgeting. They're comparing prices across 3.2 stores per trip now, up 17%. The loyalty is gone. The impulse is gone. If you haven't restructured your labor and your lease terms around that reality, the math will catch you. If you're seeing it on the ground right now, say so in the comments. Where the damage is worst, by name. The 5 retail markets that deteriorated fastest in 2025. Colliers confirmed. New Orleans, Buffalo, Pittsburgh, Providence, Milwaukee. Buffalo hit 10.8% vacancy, the highest among major metros. Pittsburgh posted negative 890,000 square feet of absorption, space leaving faster than anything is filling it. Memphis posted the worst single metro absorption in the country. Detroit was the only major metro where retail rents actually declined year over year. Every one of these cities shares the same profile. Population stagnation. Shopping center inventory from the 80s and 90s built for a middle-class manufacturing economy that never returned. Disproportionate exposure to the chains that went bankrupt, and in most cases, zero new retail under construction. These aren't coastal luxury markets adjusting to e-commerce. These are middle American cities. The strip malls built for the version of the economy that employed the viewer's parents. The factories left a generation ago. Now the retail that served the factory workers is following. Here's what happens when the corridor near your house goes dark.
Hey, real quick, if you don't mind me jumping in, if you want to learn how to make money from this and learn about real estate cycles, when to sell at the top, when to buy at the low, and then again, when to sell at the next top, they're actually pretty easy. 4 courses, put them together: real estate cycles, bear market course, home seller pro, and a really cool secret course, all together for one insanely low price. Links down below if you want. Now let's get back to the video.
Shopping centers that lose an anchor tenant often enter what commercial analysts call a death spiral. The anchor generated foot traffic. The smaller tenants, the nail salon, the tax prep office, the dry cleaner, depended on that traffic. When the anchor leaves, their economics change overnight. Some don't renew. The corridor thins. Each departure accelerates the next. When a 7-Eleven closes alone on a healthy corridor, the space gets filled in months. Fitness studio, medical clinic, coffee shop. The corridor stays active. When a 7-Eleven closes and the GameStop next to it already closed and the Foot Locker across the street pulled out, the corridor itself loses its economic signal. The comparable sales data disappears. Appraisers who value nearby homes use commercial activity as one indicator of neighborhood health. When the retail goes dark, the comps go dark with it. HUD confirmed that buyers have difficulty obtaining mortgages in neighborhoods with blighted or vacant commercial properties because of underappraisal. The appraised value comes in below asking. The lender won't approve the full mortgage. The buyer either covers the gap in cash or walks. That changes who buys in the neighborhood. The financed buyer, the young family with a conventional mortgage, gets screened out by the appraisal. The cash buyer, typically an out-of-state investor, doesn't need an appraisal to close. The ownership pattern shifts from homeowners to investor-owned rentals. Not because investors targeted the area, because the appraisal mechanism filtered out everyone else. A Cleveland study found properties within 500 feet of a vacant tax-delinquent property lost 9.4% of their value. Less property value means less property tax revenue. Less revenue means the local government cuts services. Road maintenance, policing, code enforcement. School budgets in most metros are tied to property tax revenue and enrollment. When both fall, the school loses funding. The rating drops. The families who can leave do. That's the sequence. Retail corridor thins, comps disappear, appraisals come in low, financed buyers can't close, investors buy in cash, ownership shifts, tax revenue falls, services get cut, school quality declines, families leave. The sequence feeds itself. What fills the vacancies tells you what the neighborhood is becoming. Dollar General opening 450 stores in 2026. Rural markets, towns of 20,000 or fewer. Aldi opening more than 180. Value format, necessity-driven. These companies aren't opening in thriving corridors. They're opening where everything else left. Their business model is built on serving the customer who has no other option. A fitness studio moving into a vacated 7-Eleven means the corridor is healthy. A Dollar General moving in means the market decided that block is trading down permanently. Sustained vacancy means the market concluded there isn't enough activity to justify any tenant at any price. The 7-Eleven on the corner closes. Over the next year, the GameStop in the same strip goes dark. The phone repair shop doesn't renew. A Dollar General opens in one space, the others sit. A family 3 blocks away bought in 2019. Good school, clean corridor. They list in 2027. The appraisal comes back 8% below asking. The appraiser notes reduced commercial activity within a quarter mile. The buyer's lender won't cover the gap. The deal falls through. An investor from Phoenix buys it in cash, converts it to a rental, manages it remotely. Within 3 years, the block that was 70% owner-occupied is 50% rentals. The yard work that happened because the homeowner took pride in the street disappears. The connection to the place that comes from owning it erodes. Not because anyone did anything wrong, because a sequence started at the retail corridor and worked its way block by block into the residential grid until it reached the school funding formula. By the time the school rating drops from an 8 to a 5, It's been running for years. By the time a parent asks what happened, the answer started at a convenience store that closed because the consumer who shopped there ran out of discretionary income in a year when everything cost more and nothing paid more. The national vacancy rate says 4.4%. The national vacancy rate is an average that describes nothing about your corner. Drive past the nearest retail corridor to your house this week. Count the occupied storefronts. Compare it to a year ago. Check whether what moved in is trading up or trading down. That's your leading indicator. It's more accurate than any headline. And the sequence it reveals is the one that determines what your property is worth, what your school is funded, and what your neighborhood looks like in 3 years. The data is on the corner. Go look.